Let's discuss the health of the rally with Edward Jones Mona Mahajan. So you've been listening to the backdrop, Mona. Do you think it's time for investors to change course?
Yeah, thanks, Sarah. Look, we think after a 25% rally in the S&P 500 since late October and really a 30% in the NASDAQ, could there be a possibility for a pullback, a correction, a period of consolidation? That is a normal course of action. We think that could be a likely next step over the next several weeks. And keep in mind, any given year, 1 to 3 corrections are the norm in the 5 to 10% range. But do we think that correction evolves into something more nefarious, a bear market? Probably not. And, there are fundamental reasons behind that. We point to 3 in particular. We do think the Fed is heading towards a pivot towards rate cuts sometime this year. We do think also inflation, while it has been volatile the first couple of months of the year, keep in mind, we think it'll moderate because core inflation, particularly shelter and rent components, should continue to see some moderation in the months ahead. And by the way, we could get services inflation cooling if that consumer and wage growth moderates as well. And then thirdly, of course, we continue to see an economy that, while it may be softening to below trend, is holding up pretty well. And we could see the potential for reacceleration in the back half of the year when inflation is lower and interest rates may be lower as well. So fundamentally, correction, yes, but not something more nefarious.
Why are you so convinced that inflation will continue to be down? I just mentioned some of the warnings about the stickiness of inflation, the fact that there still is fiscal spending coming into this economy, and that we seem to have stalled with the progress of lower numbers.
Yeah, absolutely. Look, we've gone from 9% headline CPI inflation to about 3%. It's been a good run. Could that last mile prove a little bit bumpier? Absolutely. And we're seeing that, as we said, in January and February. But if you strip out shelter and rent, annualized 6-month inflation and 3-month inflation is at or below 2% already. And so if you believe that shelter and rent component will catch up with what we're seeing in the real-time data. Keep in mind, if you look at things like the Zillow Rent Index or home price indices on a year-on-year basis, they've already come down quite a bit. And we know they operate with a lag when you look at the CPI basket. So we think that data will slowly and gradually flow into the CPI baskets. And by the way, keep in mind, the PCE index, which the Fed does look at pretty closely, doesn't have as high of a weighting toward shelter and rent. So already lower, and we think continuing to moderate. The other thing we'll mention briefly is we talked about a labor market that is quite strong, but may start to see some cooling. We've already seen a tick up in the unemployment rate to 3.9%. Could we get a 4 handle on that? Perhaps. And that will put pressure on not only wage gains, but services inflation broadly.
So just as far as the stock market action this week, NVIDIA 10% off its highs, Meta stopped going up. Can the overall market, the broadening that everyone's been excited about, continue without those names?
Yeah, look, if we do get a pullback and correction, we think the higher beta parts of the market, and clearly some of those names you mentioned, that Magnificent 7 cohort, large cap tech in particular, which are higher beta, probably have more room to fall than the broader market. Now, we do continue to see this broadening, and we're starting to see some signs of it already in the first 3 months of the year. We do see that as a theme playing out over the next 12 months or so, not only with cyclical and value parts of the market, but if you think about the cap space as well, and mid cap in particular, but parts of small cap as well. And particularly as we get some of these catalysts in play, if the Fed pivots lower, if we do get inflation continuing to moderate. And notably this year, we expect earnings growth to be a little bit more balanced as well, not only driven by some of those few growth sectors, but a broader participation. And by the way, earnings growth should be closer to 10% versus flattish in 2023. So we think all of those factors continue to point to a broadening of market participation, especially if the economy reaccelerates.